Hello and welcome to the August webinar from the IEA Clean Coal Centre. My name is Deborah Adams and I'm Studies Manager here. We run a webinar each month based on our technical reports. You can watch our webinars from our website or YouTube. And the reports are available from our website www.iea-coal.org. Residents of member countries and employees of sponsoring organisations can download our reports at no charge after one-off registration. All the information is on our website. The subject for today's webinar is an update on international finance for coal-fired power plants. Our first report on this important topic came out in 2017, and due to the interest in the subject and its fast-moving nature, we commissioned an update on it this year. The study was prepared by a team and the findings are presented today by the lead author, Uddin. The report is currently out for peer review and will be published in October. It will then be available from the website. If you have any questions for Mo, please submit them as we're going along and he'll do our best to answer them at the end. Thank you. Over to you, Mo.
Thanks, Deborah. My name is Mo Uddin, as Deborah has mentioned, sorry about that. My name is Mo Uddin, as Deborah has mentioned, and just as way of introduction, you can see my bio to the right. We're here today to update a previously published report by Clean Coal Centre, which was titled International Finance for Coal-Fired Power Plants. And in our update, we've included information from 2014 to 2017. And we noticed a 9% decline in financing available for coal-fired power plants and coal mines. However, we also notice over this, we note that in that sort of decline, there's a short-term time span, so you only have 4 data points. There's inconsistency of year-on-year changes. There's a gap in how we understand the different building blocks of the financing, which is a residual we call other finance or other financing. And based on 4 years of information and the sort of year-on-year changes, long-term trends are hard to decipher and to predict. So with that, we'll get into the main meat of the webinar. And the webinar starts by looking at the narrative that coal is in decline. So this is a narrative that's been evident in the media, and particularly between 2015 to 2018, we saw a number of news articles, editorials, and publications which would predict that there was no future for coal. And we look at some of the background to this and what this was based on in our report, and we summarize that in our presentation here. So we note that they reduced the projections of coal consumption. So this is a very striking graphic which explains a lot of what was driving these predictions that coal was in decline. And this graphic is basically based on the information from the Energy Information Administration, which looks at various scenarios and projections of what's happening to coal consumption. The line that you see in red is a 2013 projection. So in the year 2013, the IEA projected, looking forward, that coal consumption was going to peak somewhere in mid-2030. And that's what was perceived to be a base case. In 2017, the IEA looked back and said, the EIA looked back and said, oh, look, we've been consuming a lot less coal than we'd anticipated. And in 2017, the projection going forward suggested that the peak had already been met or was very close to being met. You'll see a slight bump in the flat line. But this really depicts 2 very different views of where the world is when it comes to coal consumption, and is the basis of many of these editorials and publications which seem to suggest that coal was in decline. These publications were supported by the threat of regulatory disruption. So one of the reasons for this decline was predicted or seen by many observers as being sort of the threat of regulatory disruption, and the foremost of these threats was seen as being the Paris Agreement, which was a number of countries coming together in a multilateral way and signing agreements to limit carbon emissions. And it was the threat from the Paris Agreement is the potential to limit carbon production, but focusing particularly on coal consumption. And the idea that these countries together could work to achieve that was seen as a potential disruption in coal use over the longer term. Then there's the Powering Past Coal Alliance. So a number of countries have come together and said that they no longer want to invest in unabated coal technology. Their coal phase out. So many countries in Europe in particular are looking to phase out coal from their power networks. There's also increased pressure from consumers and shareholders. So you've got various activist investors and consumers and environmental groups who are putting pressure on politicians and companies to change the way that they behave. You've also got commercial concerns about the changing economics of coal. So a lot of the editorials mentioned the competitiveness of coal to solar technology or wind technology, and also to gas, and suggested that coal was no longer competitive. I think we look at this, and when we're observing this information and assessing it, we say we need to be very careful about the assumptions that are made when it comes to the economics of coal, because various analyses and assessments rely on different sets of assumptions. So in many parts of the world, coal is still very competitive. In other parts of the world, it's not so much due to assumptions around taxation, how much coal costs to construct, what the environmental costs that are actually included in the price to consumers is. So in our report, we address this more on a geographical basis as well. We talk about how in Asia, it seems that coal is going to be, forecasters predict that coal is going to be competitive until 2023. But it's also quite likely that it'll be competitive for longer. And we also look at sort of certain examples where coal projects have slowed down, or there's increasing uncertainty over them. So if you look at North China, for example, you notice there are a number of restrictions on the development of coal power plants. And this is primarily due to smog, so not carbon pollution, but smog. And smog resulted in significant changes in the planning of new power plants, but also in the operation of existing power plants. And this provides examples of how coal was no longer seen as being this dominant fuel source, which is going to carry on increasing in consumption. Then you also have the Adani Carmichael mine in Australia, which has reduced from 16.5 billion Australian dollars to 2 billion Australian dollars. And it reflects the fact that that there was increasing pressure on the government, on developers, and on banks to reduce their sort of exposure and support for these coal projects. And whilst this project is ultimately going ahead, the pace of it and the size of it has slowed down. The pace of it has slowed down and the size has decreased. So all of this together has helped to build this narrative that coal is in decline. However, that's not the full picture. And next, we look at the alternative narrative that coal is here to stay. And as you note from the diagram that we showed you in the first slide, that actually coal consumption is flatlining, it's not declining. And what we see here is that consumption is plateauing and not declining, as I just said. And what you'll notice in particular from this diagram that's been produced by the IEA in 2018 is that countries in the developed world, US and EU and China, are forecast to decrease their consumption of coal in the near term. But at the same time, you've got countries in Southeast Asia and India, which are looking to increase their consumption of coal. So the real sort of way in which coal is going to move in the short term, and admittedly in the long term, is around how consumption in the West and China decreases, and how it increases in India and Southeast Asia. And on balance, that will determine where the direction of coal is going. oops, this is apologies for that, just having some slight technical issues. So coal is a rational choice for many countries. Without the existing, and so as we saw in the slide before, it makes sense that some countries are continuing to invest in coal. As we said, that there are threats of regulatory disruption, investors and consumers being concerned about the potential implications of coal and also the economics of coal. But there is still a rationale to invest in coal. So many countries in Southeast Asia, in India, where the existing gas infrastructure is either not there or it isn't in a state where it can be used to encourage gas-fired power generation, coal may be more cost-effective. It's also like when we compare investments, we typically look at the levelized cost of electricity. The levelized cost of electricity is based on both, if you were to have new generation of energy from coal, but also renewables and gas and other sources. And often that doesn't factor into account that there's lots of existing coal generation already available. So that will be the source of much of the coal power generated. And when we're comparing sort of the two costs, we need to factor into account that it's probably cheaper, and it is cheaper to run existing coal investments than to invest in new renewables. And finally, we need to think about the socioeconomic benefits, including employment and taxation that the coal sector offers. So regardless of which part of the world you're in, whether you look at Wales, Pittsburgh, whether you look at South Africa and Johannesburg, whether you are looking at different places in China or Southeast Asia, coal mining provides significant jobs and tax receipts for the government. And therefore, sort of moving away from coal also means moving away from those economic benefits. So countries need to make trade-offs on what they value and how they want to proceed in their development pathways. And that obviously has an implication of why some countries carry on investing in coal. What we see, though, is also an adaptation to future regulation or future regulatory disruption. So cleaner coal technology seems to be more abundant. So we've looked at the World Economic Power, the Worldwide Energy Power Plant Database produced by Platts. And what we notice is that ultra supercritical plants, which are more efficient and produce less carbon dioxide per unit of power, have increased by 10% between 2014 and 2017. Equally, though not mentioned on the slide, there's been a reduction in the subcritical capacity, which has gone down by 15%. This is explored a bit in our report, and I'd encourage you to have a look if this is an area that interests you. So we've looked at these two narratives around coal. One of them talks about how coal is in decline. The other one looks at how coal is here to stay. But we now look at sort of what we've been looking at in terms of our analysis, which is what's been happening to the coal financing environment and what are the trends within this environment that we can see. So we note that, just to give you an overall picture of what's happening in the financing space, we do a quick recap of the different entities involved and how they're lending to how the financiers are lending to the borrowers. So on the very left-hand side of the slide, you've got institutional investors and company balance sheet. These are sort of the sources of finance which are then lent on and to the borrowers. You've got commercial banks, multilaterals, and public financial institutions. These are the three big financiers. They lend in different ways to mining companies, utilities, and power plant developers. So if you're a commercial bank, you may help one of these companies to issue out shares, and you do that by underwriting those shares, or you might support them in issuing out bonds that institutional investors might buy, and therefore buy a part of the debt of the company that, or the borrower that's going to be developing these projects. You have direct loans to developers and utilities. You have risk guarantees and loans. So public financial institutions and multilaterals may provide a risk guarantee, which says that we will provide certainty, or in case of losses, we might provide certain amounts of loss recovery to you. And then finally, you have balance sheet financing or equity financing. So a company may decide based on the profits that it's made to invest in future projects, taking into account the profits that it's made and just moving those over to new projects that it's looking to invest in. When looking at financing flows for new investments, there are different definitions of new financing, and we've come across this in the literature that we've reviewed. There's finance at commissioning. So this is the finance that you think is required if you were to look at what it's taken to develop a project at the state that it's operational. So the World Energy Investment Outlook looks at this, and they look at sort of what the financial cost of the project is after or the day it's been commissioned. And they use that to come up with estimates of what the total financing in a particular sector is. You've got finance at drawdown stage. So this is as a developer or utility is borrowing to invest in new projects. BankTrack, Urgewold, the Rainforest Action Network, they all monitor financing at drawdown stage. And then you've got financial close. And this is the information which is when the funding becomes firm. So public financial institutions, the National Resource Defense Council, and other organizations are interested in this number because it's the point at which the commitment is made, and you know that the funding is now there and available for the project. Now, it's quite difficult to try and merge all these funding sources to come up with a holistic picture of what's going on. A project may receive financial close, but drawdown might be a few years later. It may be split over a longer term than intended. Finance and commissioning may be different because by the time a project has been built and changed, the financing environment has changed, and therefore the underlying information where you've got a power plant costing, I don't know, $200 million is now costing $150 million. So it's quite difficult to merge the information from these different sources. And I think we need to be very careful in how we talk about this information, because we are measuring different things at different time points. And whilst, as people may be interested in just the overall financing picture, like this is a particular nuance that we need to be careful of. So the big financing picture. So what's been going on in the past 5-6 years between 2014 and 2017 in terms of the commitments made and the disbursements on an annual basis. So what you'll notice from this table is that between 2014 and 2017, there's been a decline in financing. However, it's not continuous. So in 2015, financing falls, but then it rises again in 2016 compared to 2015, and then it falls again. And this sort of trend is reflected in almost each of the financing categories. Now, of the two biggest financing categories, financing from large banks and other financing, we've broken that down by power plants and mines. And it shows you how basically funding from mining seems to have decreased over between 2014 and 2017, but funding for power plants has increased from large banks. In the other financing category, however, we see that financing for mining has increased, though we can't explain where exactly it's come from, and financing from power plants has decreased. Now, I'm sure you guys have lots of questions on what other financing is and what large bank financing is as well. So large bank financing is financing from the top 20 banks to some of the largest developers and utilities. And other financing is the gap that we're not able to explain, but we discuss in depth both later in this presentation, but also in our report, which looks at, we can understand a total based on the information that we've collected. We've got a breakdown of the different segments of where we see a lot of this funding coming from, but what explains the rest, and that's the other financing. So, coal financing, the environment and trends for commercial banks. So as I noted above, like commercial banks are some of the largest sources of known finance. So we look at them in a bit more detail, and we look particularly at the segmentation of Western to Asian banks. So one thing we'll note is bank lending between just two data points, 2014 and 2017, has increased, right? Like that's pretty apparent from this diagram. It's not been uniformly increasing. Like in 2015, it shot up and then it's gone down quite a bit in 2016, and a little bit in between 2016 and 2017. So funding year on year is not consistent. And what we also notice is that Asian funding as a proportion of total of Western funding is higher than it was it was higher in 2017 than it was in 2014. Now, what does that mean? So in 2014, we looked at the information. We said in 2017, looking at 2014 information, we looked at we came up with a view that there was likely to be a substitution effect in how Western banks will be displaced by Asian institutions, which are more happy to lend to coal projects. Actually, we don't really see that in the data that we've got between 2014 and 2017. What we see instead is Western banks are lending more than they were Western banks are lending more in 2017 than they were in 2014. And whilst the changes are not consistent, the overall narrative that they're not lending or they're not lending as much to coal sector projects is not true. Both across coal-fired power plants and across coal mines, lending seems to be higher. And so we looked at this in a bit more detail because this is quite an interesting story. Often we hear in the news how X bank has put out a policy saying they're not going to do X or they're not going to do Y. So we looked at two big Western banks. In this case, we looked at Morgan Stanley and JP Morgan. And we looked at, they both have policies which restrict lending to coal projects, but we note that lending between, and we've charted out the lending between 2014 to 2017 that they've done for both coal-fired power plants and coal mines. And we see that basically one bank has been lending more and the other bank has lent more in 1 year, but is generally lending less. Now, this is quite interesting because it seems to suggest that there's a wide latitude in the policies that banks have and how they lend, which is true. They're voluntary policies and they're different between banks. And so there's no clear sort of one approach by Western banks. They have the opportunity to lend, and some of them are lending and financing projects, and others are reducing their exposure and lending and financing to coal projects. We also looked at Asian banks, and we were interested in particular in whether or not Asian banks continue to lend and increase their exposure to coal projects. So large Asian banks, particularly Chinese ones, are providing significantly more funding to coal projects than Western banks. I think that's evident. So on the bar chart to the left, or to the right, we've shown what Asian banks are lending compared to total Western financing, total Western bank financing to projects, both coal mines and coal power plants. And we can see that sort of Asian banks are lending between 1.5 to 2 times what Western banks are lending. And the vast majority of this is driven by China. So there are 4 big banks in China which top the league when it comes to bank financing of coal projects. Now, it's worth thinking about whether or not these are commercial projects or whether they're public PFI loans or public financial institution loans. And I think this is something that, is an ongoing discussion in the literature that we've reviewed, but also in our minds, because a lot of these banks have significant shareholdings from the state. And so it's worth thinking about where we consider these loans to be coming from. Nonetheless, even Asian, we notice in Asian banks that there have been some sort of changing policies, or at least some observable behavior, which suggests that things might be changing. So we noted that 2 banks, ICBC and CCB, once 2 of the largest banks in China, rejected the opportunity to finance the Carmichael coal mine in Australia. Now, it's not inherently clear why that is, and there could be a number of reasons, including sort of their relationship with the developer of the power plant, the financials of this particular mine, the fact that it's also being financed by the state government of another country, so on and so forth. But we also notice, for example, that 2 non-Chinese Asian banks are also reconsidering their policies towards coal. So these are banks in Japan, so Daiichi Life and Sumitomo Mitsui Trust, and OCBC and DBS in Singapore. These banks are have developed new policies on lending to coal power plants, and it's possible that these policies will be taken up further by Chinese banks and other banks in the region. So, as we noted, banks lend to coal projects in primarily two different ways, or three different ways. They provide direct loans to companies which develop these projects. They may provide underwriting support to shares. So when a company goes out and wants to raise more financing, it might issue out new shares, which is known as equity financing. Or they may issue out bonds or debt, which will be underwritten by a bank but bought by an ultimate end party, which are typically institutional investors. So these institutional investors buy the shares and bonds which are underwritten by banks. And we noticed that a large proportion of investors seem to be Western and non-Asian. So whilst previously we looked at financing and from sort of Asian banks and Western banks, that financing is not necessarily just given directly by the bank. A lot of that is the banks issuing out shares or bonds that they're underwriting to these companies. So it's quite interesting to note that the end consumers of these loans may be sort of Western or Asian investors in different parts of the world. One thing that we note with sort of a lot of interest is sort of that, you know, historically it might have been sort of investors in the US and Europe who were very interested in these, and that may have changed. So the diagram that we've represented on the pie chart on the right, which looks at sort of where these institutional investments are currently coming from, is based on historical information. It's not really showing the change in exposure that these investors are seeing. So it may be that sort of new investments are being sort of more funded by a particular type of investor rather than the other. And the big sort of story or the narrative here is that European and Western investors are investing less in coal assets than Asian ones. It's not currently the story of how the asset ownership is currently distributed, but changes in this in the ownership may show these trends. What we also see is certain groups increasing their exposure, whilst other groups are decreasing their exposure. Now, we notice, for example, that AXA, BlackRock, and Vanguard have increased their exposure to coal assets. Also, interestingly, we've noticed that the Norwegian Sovereign Investment Wealth Fund has increased its exposure, though this must be caveated with the fact that they decreased their exposure quite substantively between 2013 and 2015, and there was an increase in exposure in 2017, but that was based on a year-on-year trend. So overall, compared to 2013, their exposure is probably still lower. And then we also noticed that there are two other sovereign investment funds which are divesting or have been quietly divesting from coal. We've provided links which we show on a later slide for each of for the information for these, because we know that viewers might be interested in how these groups or these institutional investors have been changing their coal exposure, and we've discussed this in some greater length in our report. So, coal financing environment and trends, public financial institutions. We note that public financial institutions have been increasing their lending to coal. We haven't recreated the graph that we'd originally shown, because it basically just shows that year-on-year trends in PFI financing, but they're not that significant in the overall financing picture. So we more wanted to talk more qualitatively about what's been happening in this space. So PFIs are basically state-owned banks and export credit agencies that are providing support to projects that are being developed either in a country or domestically or in a foreign country, and they typically tend to support developers from the same country that they belong to. So PFI contributions are growing due to continuing uncertainty in commercial markets. This is something that we see. So projects are increasingly relying on PFIs to provide guarantees or loans, or to encourage other banks to lend to projects. The vast majority of PFI support is currently coming from 3 countries: China, Japan, and South Korea. These countries have well-known sort of public financial institutions which provide export credits and insurance to lenders. And we talk about them in some depth in our report. And then we also look at some of the key recipients of the finance between 2014 and 2017. These are countries like Indonesia, Vietnam, and Bangladesh. They vary, their creditworthiness and investor appetite for investing in power generation in these countries varies. And therefore, the role of PFIs is quite important in leveraging finance to achieve the development of some of the projects that we see being built in these countries. Next, we look at coal financing in multilaterals. So when we published our 2017 report, we noted that multilaterals had primarily been moving away from coal. And that pretty much holds today as well. We note that multilateral financing, the environment doesn't look too different to what it was in 2017. The only difference is that the African Development Bank has moved on the spectrum from not being willing to lend to showing indications that it may be interested in lending to coal power plants. And the rationale there is that sort of they believe that it's important for the development of countries, of their member countries, and therefore they see value in supporting this development. The vast majority of other multilaterals have kept similar policies to what they had previously and are not very interested in lending to coal projects. The AIIB and the Islamic Development Bank have shown a greater willingness to look at coal projects, but they're not currently actively considering new coal projects or developing new coal projects. The Islamic Development Bank, as we discussed in our report, has shown a willingness to co-finance a project that was previously under development, but that has not yet achieved sort of financial closure, and commitments haven't yet been made, so it wouldn't count under our 2015 to 2017 financing definition. However, the picture is not perfectly clear. Multilateral financial institutions have been accused by some environmental groups of indirectly lending to coal projects. So the World Bank, in particular through its private development arm, the IFC, has been accused of supporting coal projects. The IFC as an organization provides equity investments and loans to private sector companies in the developing world. And these typically include utilities and banks. And these utilities and banks often take this money in a general pool and then they invest it in different projects. Now, some of these projects are coal-fired power plants and coal mines. So IFC is investing in a bank in Bangladesh. And then the bank in Bangladesh may invest in a coal-fired power plant. And that's how some groups have accused the World Bank and IFC of lending to coal projects. We hope that this information is captured under lending by banks, and so we don't really look at this separately in our assessment of different avenues of coal financing. So coal financing, environmental trends, other loans and financing sources. So other financing. So there is a significant unknown in how we calculate the financing by different segments across this time period. So we've got the gap. So the top-down estimate that we've used in financing year on year is based on the World Energy Investment Outlook. It's based on the overnight cost of financing of different projects. And then we've tried to break that down by the different constituent parts of funding from multilaterals, funding from large banks, funding from PFIs, and worked out what the other financing gap is. So in our report, and if you were to read that, you'd find out a breakdown by power plants and mines. But since we don't have the time to go through that level of detail at this moment, we just look at the other financing gap, and we provided a brief breakdown in two boxes of where that gap comes from in terms of power plants and mining for 2017 information. So so it's a difference between what we know and the value estimates to be the total, and the difference is likely to be made up of equity. So balance sheet investment. So when, as we mentioned previously, a company that's making a profit decides to invest in new projects. That's something that we haven't been able to capture in our study. Equally, sort of sustaining capital investments. So there's not new borrowing, but something that companies, particularly mines, invest to carry on new investments that the mine carry on making to maintain their capacity. There's also lending from smaller banks. So we've currently just captured lending from the top 20 banks, but there will be smaller banks that are also lending, which won't be too significant, but they will constitute an amount of funding that hasn't been captured and is currently in the other financing pot. We also haven't really considered government subsidies, particularly in emerging markets. So currently, governments do provide subsidies to power generation, and whether that's in the form of increased tariffs or sort of subsidies when full tariffs aren't paid by consumers for power. That is a government injection or government injection of equity into a utility, and that's something that we expect to constitute quite a bit of the power gap in emerging markets. And then there are other gaps and other sources of the gaps that we'd welcome listeners and readers of our report to suggest to us, because we see this as an exercise in trying to work out where this big known unknown is coming from. And we would welcome thoughts of areas that we haven't really looked at that might potentially explain the gap. So I think the key message from our side is that other financing is persistent and it's significant. So on this slide, we attempt to show you the scale of the gap, and we look at it from the power plant perspective, and we look at it from the mining perspective. So year on year, we show you what the other financing is and what the total financing by power plants and by mines is. So you'll notice between 2014 and 2016, other financing is around 50% or more than 50% for both mines and power plants. In 2017, other financing for power plants is a lot lower, but other financing for mines is significantly higher. So it basically shows us that it is a very important thing to be aware of. It's a large gap. It doesn't seem to be captured by the existing literature or the existing sources of financing information that are being aggregated. We do have possible explanation for it that we've discussed in the slide before: balance sheet financing, government subsidies, smaller banks. So it is something that we can look at in a bit more depth, but it is still an unknown. And it's quite a large unknown. So it's just something that we should be conscious of. Finally, so our conclusions from this study. So we looked at short-term trends. So we noticed that there's a slight fall in financing, and that there's been an increase in coal mining financing, but a fall in coal-fired power plant financing. This is quite interesting because we hadn't necessarily expected this, but it would make sense in a way if sort of new power plants are not being built at the same pace as was expected or was previously happening, but coal mining capacity is still needed to maintain to carry on producing power from existing power plants. What we do note is that data is inconsistent, and there seems to be only one sort of universal trend across these 4 years, which is that financing from Asian banks has increased. So basically, short-term trends are hard to determine because year on year the data changes. And it doesn't allow us to make sort of robust conclusions that we can say X is happening, and we see this across those 4 years, and this is the trend that we're seeing. And basically that feeds into our description for long-term trends. It's hard to infer trends holistically or by segment because the information just changes year on year. And it's quite hard to work out whether this is a responsiveness to structural, cyclical, and regulatory changes, or whether it's a response to commodity cycles. And I think that sort of only assessing this over the longer term, so over a 10 to 15-year time horizon, would allow us to even start to come up with those sort of conclusions on long-term trends and what's happening. Finally, so other financing. This seems to be the big area where there is a gap, and we just want to touch upon it again. It's quite important. So we look at total investment, and we look at other financing and for mining and coal power plants in the diagram, it basically impresses upon us the same point that we made before, that this is quite significant. Existing secondary literature, secondary information and literature on coal finance has missed out on a large building block of the overall financing. And we look at potential areas of future research that could be done to work out where this is. And again, we invite our listeners and the readers of our report to provide us with suggestions of what we might have missed or areas that they think we should explore to understand this gap further. Finally, in our conclusion, we just acknowledge the data challenges that we've experienced and how sort of, the findings of a study like this are subject to a level of uncertainty because of the data availability and the lack of consistency. So just to go through each of these things, data availability, we only have 4 data points, 2014, 2016, 2014, 2015, 2016, 2017. It's very hard to infer any long-term trends from these 4 years of data that we have available. We also have challenges in data aggregation. So data is coming from different sources. Now, these sources are not necessarily using the same definition of finance, but also the way that they collect this information may change year on year as the methodologies become better and they improve, or they change the way that they collect information to reflect their priorities. And then finally, we would like to caveat our report with that this data has not been verified with the groups and individuals that produced the primary research. And we just want to acknowledge that and acknowledge that we haven't checked these numbers with them directly. With that, I want to thank you for listening to our webinar. I want to give you the opportunity to ask us any questions and to send us feedback and comments on our report. You've got my email there at the bottom. So if you're able to, if you've asked any questions now, I'll try and respond to them. If you haven't, please feel free to email us to ask us those questions. So we've received a question which says over 200 gigawatts of coal-fired power stations are under construction and more are planned. Many of them are in Southeast Asia. It's probable that in some cases a renewable power plant, a solar or wind power could provide lower electricity costs overall. The 2015 Paris Agreement includes an agreement that rich countries will help poorer countries. So what are rich countries planning to do, if anything, to help poorer countries obtain the necessary finance for capital costs of renewable power plants? Thank you for this question. We noticed that sort of like, so in previous work that we've done, we've noticed that a number of sources of finances are available to renewable energy sources. These range from sort of green climate funds set up by organizations like the UN to World Bank financing available particularly for renewable projects. We haven't really looked in depth in the sources of finance for renewable energy projects. So we're not able to answer this question directly. What I would say is that, look, so this question addresses multiple points. One is, what is the cost competitiveness of renewable projects versus coal projects? I think we need to be careful when we talk about cost competitiveness because there are multiple assumptions that underlie some of these calculations. So when you're looking at levelized costs, we talked about, where are the assumptions coming from? Lazard's, which is a pretty reputable source, primarily bases its levelized costs on US assumptions, so assumptions around US tax, US construction costs, US operation costs, etc. Those assumptions don't necessarily hold in Asia. A lot of the reports that we've read, and as a company, Economic Consulting Associates, where I works a lot in Southeast Asia. We notice in the due diligence reports that we do and in the the power plants that we developed, that coal is still competitive in many of the environments. In terms of, so that's the cost competitiveness side. In terms of what financing is available, we haven't really looked at that as assignment in detail, but typically multilaterals, donors and donors from the West and governments themselves provide some sort of subsidized financing for renewable energy projects. We also notice a question: is the China Belt and Road Initiative a major contributor with finance from China to support new construction projects? So we looked at the Belt and Road Initiative as part of the previous report. And as part of this assessment, we looked at it, but we didn't look at it in terms of this is the only project that China is supporting. But yes, it is a source of financing. So particularly when you look at countries like Pakistan, you notice a number of coal sector investments, which are coal sector investments supported by China. Okay, so we've got another question from Milton. Thanks for the presentation. Oh, that's very nice of you, Milton. If you have any other questions, please email them to us. We'd be very happy to answer them. If you're listening far beyond the point at which this was presented, please feel free to email us. I'm very happy to answer questions. It's an area of interest for us. Thank you. Just one last thing to say. It's that we are now out for peer review. So if you have the opportunity to review the document and email us back feedback or comments or questions that you might have, please do so. Thank you.